Hello and good morning, everyone. Welcome to Almus Market Mornings, your daily dose of financial updates. I'm your host, Swaraj, and I have with me JK, and we'll be covering the latest developments. Now, usually in our market mornings, I start off with some developments just to set the context, but this weekend was quite intensive when it comes to sports. So I thought I'll cover that while JK will cover the market mornings. Now, of course, Gujarat Titans won the title yesterday on their debut season. They played wonderfully throughout the season. And if you're a Formula One fan, Red Bull had a very good day with a 1-3. Checo Perez winning the Monaco Grand Prix. While personally, I was rooting for Charles Leclerc, who didn't have such a good day starting from pole and finishing fourth. It was an interesting weekend when it comes to sports. Hopefully, the markets will be interesting in the week ahead. JK, what developments do you have for us with respect to the markets?
Yeah, good morning. We are actually starting also on somewhat a positive mood in the markets. In fact, the S&P 500, which had moved into the bearish territory the previous week, saw a rally of 2.5% on just the Friday. And overall week, it had a gain of 6.6%, which is the largest weekly gain so far this year. Markets also chose to like the fact that personal consumption expenditure rose by 0.9% versus 0.7% expected, and in real terms. Even though the personal income was up only 0.4%, basically the population is dipping into their savings. Core inflation was lower than last month, though broadly matching the expectations. But coming after some softening in the CPI headline from 8.6 to 8.3 earlier in the month, investors are tending to discount a pause by the Fed after July meeting. One more good news was that global equity funds saw inflows in the week to May 25 for the first time in last 7 weeks. There is also a news from China saying that they will be opening more and more activities, particularly in the industrial belt, and the economic activity should pick up. All these things have given some fillip to the global risk markets. On the other side, yields are maintained at lower levels after the rate of inflation showed no further rise, while some read Fed's success in tightening credit and slowing price rises. The 30-year is now consistently below 3%, 10-year is off nearly 50 basis points from the top. On the economic data side, there were mixed indicators from the US: slowing inflation, strong consumption, falling incomes, cooling home sales data, and importantly, lower trade deficit, which means that the growth number for Q2 may be better, because in the Q1 estimates that we have got so far, high trade deficit has dented the growth numbers. And along with the fall in trade deficit, consumption remaining at high also will support. So overall expectation is that Q2 will be better for the US. One can say that the disconnect between US consumer, what they say and what they do, is stark when you look at the Michigan University Consumer Sentiment Index, which actually came much lower, but actually they have been spending much higher. Oil has seen another high at 120, and Bloomberg reports that some EU leaders are leaning towards a deal that would ban Russian seaborne oil while temporarily sparing deliveries through a key pipeline to give landlocked Hungary more time to reduce their dependence on Russian oil. Governments are also discussing a plan with the European Council and European Commission that would make shipments of oil through key ports exempt for a limited period of time from a broader ban on oil deliveries to the bloc. The move has actually supported the oil prices, now Brent trading near 120. On the dollar, it lost some more last week and closed near its lows, the second straight weekly decline, as the traders spared expectations for US Federal Reserve interest rate hikes, and as improving inflation and consumer spending data eased recession fears also. Lower yields have been encouraging pairing more dollar longs broadly, and notably against the yen, which has seen a big weakness in the last few months. As we are running into a week packed with important data, we expect it to hold 10150 103 range, with bulls looking somewhat nervously at the increasingly hawkish ECB. Of course, gold continues to underperform. Again, the high yields attracting more money into the bond market, and the last previous big falls in the gold has actually taken away some of the speculative traders from the gold market. But fundamentally, it seems to be supported, and on good dips, the central banks are supporting the prices, which should see it around 1800 as the base. If we do get a confirmation of inflation peaking and possibly an indication of pause by the Fed after June and July hikes, dollar could see much larger reversal to the downside, in which case gold can also rally. Technically, the monthly chart shows possible formation of a bearish pattern at the end of May, and unless something drastically changes today or tomorrow, such a setup would generally hint at a weak dollar scenario for the coming weeks. Coming into the rupee, it's been a picture of stability, behaving true to clear-cut remarks of the governor recently that they would not allow a runaway depreciation of the rupee. Market has not stopped buying on dips, not just from the oil companies, but even the ever-present FII outflows, and now even some FDIs are being mentioned. Constant demand at 77.50, at the same time consistent offers at 77.70 has boxed it in a very narrow range. Usually such a long period of narrow ranges would result in a spring action of big move. We keep assessing which side that move can happen on the rupee. Right now, we stick to the range of 77.50 and 77.70. We will have Q4 GDP data of India to be published tomorrow, expected to show 4% versus 5.4% in the third quarter. But a lot of impact is coming from the unfavorable base effect, as can be seen from the fact that Q4 22 compared to Q4 19 actually shows 8.6%. That means we are comparing with pre-pandemic period. So as of now, expectations of above 8% for full year 22-23 growth is being maintained by most analysts. Last to mention, US market is closed today. So there will be no cash transactions for corporates at the banks, but banks will deal for term and spot and forward deliveries. Thank you.
Okay, thank you, JK, for taking us through the developments. And as JK mentioned, that it's going to be a week packed with important data, especially with the Q4 GDP data of India to be published tomorrow. That's it from our end. Have a very good day, everyone. We'll see you all tomorrow. Bye-bye.